Okay, so good morning all of you students. So this class is for class 11 accountancy and we are going to deal with the chapter 5. Okay, in the previous class we were doing the accounting equation. Okay, in the previous class we were doing the accounting equation and the periodic test is being held, and you know that you are giving your test and everything, you would be submitting your papers very soon, but we have to run off with the syllabus forward for the first semester exams also. So you can continue from chapter 5, that is the double entry system, rules for debit and credit. Okay, in this chapter we are going to deal with the double entry system, the rules of debit and credit, that is how accountancy is done, or how accounts are being made, or how accounts are being prepared in a firm or an organization. Understood? So first we have to understand certain rules, regulations, and on what basis we are going to prepare it. For this only we are going to deal with this chapter. After that we will be jumping in straight into the journals and ledgers, that is the proper accounting, how we are going to do. Okay, so double entry system. Double entry system, we are going to start from here. I have written certain points on the board also. You would be getting certain information from here, and if you have the book, open up chapter 5. Okay, the first page. From there only I am going to teach you that what is double entry system. Double entry system is okay, moreover newer thing only, but recording of transactions. Double entry system is a type or way of recording of transaction. Recording of transaction in a business firm. But recording of transaction in a business firm is not a new concept. It is an ancient concept to record the business transactions in the book. Okay, maybe at that time they were not following the double entry system, but they were following certain methods by which they were recording the transactions. Okay, that information is given in the first paragraph only. If we read, we will get the information. Recording of business transactions had been in practice since ancient times in all countries of the world, not only in India or not only in other countries, European countries or American countries. All over the world, recording of transactions was being made. In India, accounting was a norm and a system to follow, as it was always there. In India, accounting was a norm. Norm means minimum requirement for a business transaction business to run. Minimum requirement was that the transaction should be recorded. Okay. Kautilya is famous. If you remember this name, Kautilya, he was a famous mathematician and philosopher also. So Kautilya's famous Arthashastra, his famous book is named as Arthashastra. Now also we get it online or somewhere in the bookstores. You can read, even we can have in our library also. Kautilya's famous Arthashastra not only relates to politics and economics, it generally mainly relates to politics and economics, but also explains the art of account keeping. But it also explains the art of account keeping, means how to prepare the accounts and how to record the business transactions. It was written in 4th century BC. It was written in 4th century BC, that is before Christ. The book gives details about account keeping. The book gives details about account keeping, methods of supervising and checking of accounts, and also about the distinction between capital and revenue, income and expenditure. It doesn't give only the detailed methoding of how to keep the accounts or how to record the accounts, but it also distinguishes between capital and revenue and income and expenditure. It also gives detail about those things. Okay, now we are going on to move for the first point, that is origin of double entry system. How did double entry system originated, from where it originated, the information is given over here. It basically originated from Italy, but later on it was developed by England. Okay, let's see what is given in the book. The double entry system was introduced to the business world by an Italian merchant named Luca Pacioli. Okay, Luca Pacioli was the Italian merchant who first introduced the double entry system in 1494 AD. In 1494 AD. In his book, he explained the recording of both aspects of a transaction. I have told you in the previous classes also, when I was teaching the first or second chapter, basic principles of accountancy and something. In a business firm, whatever business is going on, what happens, the business transaction which is going on, it is on two-sided. It is always two-sided. One is paying something and one is getting something. Okay, or one is selling something, one is purchasing something. This type of transaction is from two ways, two-sided. So in the previous terms, in the ancient times, it was not recorded on the both sides. It was recorded only on one side. One-sided accounting was done. Okay. But double entry system is that only. The main word double means that only, means both sides. Okay. We explained the recording of both aspects of a transaction. In one transaction, there is two aspects. One is the receiver, one is the giver. Okay. And accounting books of journal and ledger. And he also introduced the accounting books like journal and ledger. I would be explaining about journal and ledger in the next chapters that we are going to deal with those chapters only. Okay. This book became very popular due to its feature. In 1544, the book was translated from Italian to English by Huge Old Castle. Okay, this book was in Italian language and it was later on transcribed or translated in 1544 in English by Huge Old Castle. Huge Old Castle translated that Italian book into English language. Afterwards, many changes were incorporated in the system, and then in 1785, Edward Jones wrote the book on double entry system. And later on, lot many incorporations were done in that book. Incorporations means changes were done in that book, and later on, it was finally published as a double entry system by Edward Jones. Okay, 1785. Wrote the book of double entry system named English System of Bookkeeping, and that name of that book remained English System of Bookkeeping. In this book, he revised the system along with explaining the subsidiary books, that is cash book. In this book, he also revised the system of cash book also. He didn't only said about journal or ledger, he also said about the cash book, that is the record of the cash of the business. Okay, cash book, purchase book, sales book, and also the trial balance. He gave all those books, and even if the trial balance also in that book. Through the system of recording business transactions in a systematic manner had originated in Italy, it was perfected in England and other European countries during the 18th century only. Though it was originated, the double entry system originated from Italy, but it was perfected. Perfected means it was polished and made very clear or made very smooth for a business firm to run their transaction recording in the books by England only. Okay, and the other European countries during the 18th century. Okay, after the industrial revolution took place. If you remember properly in class 8, 9, 10, you have studied history. The industrial revolution in England took place in the 17th century. So in the 18th century, the double entry system came in a polished manner. Many countries have adopted this system today. Many countries are adopting this system or have adopted this system today, and all are running in double entry system only. Okay, what is the meaning of double entry system? What is the meaning of double entry system? There are numerous transactions in a business concern. Each transaction, when closely analyzed, reveals two aspects. There are numerous transactions in a business concern. Numerous transactions to take place in a business organization. Okay. Each transaction, when closely analyzed, when you closely analyze or see the each and every transaction, reveals two aspects. It always gives you two aspects of one transaction. That one is being one person is selling and other person is purchasing. The two aspects are shown very clearly. Okay. One aspect will be the receiving aspect or incoming aspect, or the expenses or loss aspect. Okay, this is termed as the debit aspect. All the incoming aspect, receiving aspect, or expenses or losses aspect will be the debit aspect. Okay, the other aspects will be the giving aspect or outgoing aspect or income or gain aspect. All the giving aspect, outgoing aspect, or the income or gain aspect is known as the credit aspect of the business transaction. Okay, so one is the debit aspect and one is the credit aspect. That only I was saying that one person is purchasing, one person is selling. Okay, so this thing happens over here. When this thing happens, one person becomes the debitor, one person becomes the creditor straight away. So what is debit, what is credit? The difference over here is given very clearly. Okay, receiving, incoming, or the expenses and losses comes in the debit, or giving, outgoing, or losses and gains, income and gains come in the credit side. These two aspects, namely debit aspect and the credit aspect, form the basis of double entry system. These two aspects, that is the debit aspect and the credit aspect, together they form the double entry system. This is the meaning of double entry system. In a double entry system, there are two aspects, that one is namely the debit aspect and one is namely the credit aspect. Okay, the double entry system is so named since it records both the aspects of a transaction. Double entry system is so named as double entry system. Why it is named as double entry system? Because it records both the aspects of one transaction in the books of accounts. Okay, in short, the basic principle of this system is that for every debit there must be a corresponding credit of equal amount, and for every credit there must be a corresponding debit of equal amount. In double entry system, what it explains or says, that for every debit you are doing in your books, there should be a corresponding equal amount of credit also, or every credit whatever you are doing in your book, there should be corresponding equal amount of debit also for that. Okay, there are some definitions given over here for double entry system by J.R. Batley or William Pickles. You can learn them, and you have to use those definitions only. If it is asked that in questions it is asked that define double entry system, then you have to define by the writer's name only. Or if it asks like explain or what is double entry system, you can explain it in your own words, which I have explained it now. The meaning you can explain. Now coming on to the next topic, that is the characteristics of double entry system, that is DES. I have written in the short form DES, double entry system. Principles or characteristics, both are same thing. What are the principles or characteristics of double entry system? There are mainly four. I am mentioning over here and explaining it to you. Number one, every business transactions affects the minimum two accounts. Every business transaction affects minimum two accounts. Okay, whatever business transaction is taking place in the business organization, it would be affecting two of the accounts of your business. Okay, it may be a purchase, sales, cash, or some personal account of some person, whatever it is, because two aspects are there, both the aspects will be recorded, so two accounts will be affected by that. Okay, number two, recording of both personal and impersonal aspect. In double entry system, we not only record the personal account system but also the impersonal account system. We are going to deal with the personal and impersonal. What are those type of accounts? I am going to tell you. Like you can see over here, it is given on the chart also. I am going there only. Number three, recording of transactions as per certain rules and regulations. All the transactions whichever are being recorded in the business organization, it should be recorded pertaining to certain rules and regulations. Okay, otherwise it would be affecting the other books of accounts in your business organization if you don't follow the rules and regulations, as I have mentioned in the basic principles of the accountancy in chapter 2 or something. Point number 4, preparation of trial balance. After doing all the accounting system, all the books have been prepared, the trial balance should be prepared by the business organization. Trial balance is not a very reliable balance sheet. It is a type of balance sheet only, but it is not a very reliable type of balance sheet. You have to prepare a proper balance sheet at the end of the year. That is different matter. But trial balance you can prepare. It is a kind of balance sheet, but it is not only prepared at the end of the year, but it can be prepared in the middle of the year, wherever you want. Okay, it can be 3 months, 6 months, 9 months, whatever it is, or maybe 4, 8, 12, whatever you want to prepare. Means when the journal, ledger, cash book, purchase, sales, purchase return, sales return, all those things have been prepared, all those things are ready with yourself, you can prepare a trial balance for yourself so that you can get your profit or net profit from there. Okay, now coming on to the rules of debit and crediting. Rules for debiting and crediting. How will you know that what thing should be going into the debit and what thing should be going into the credit? Because every account has two aspects that I have told you. That one is on the left hand side, left hand side will be this side. Left hand side is your debit aspect and right hand side is the credit aspect. Okay, so rules for debiting and crediting in the accounts. So first of all, you have to understand the accounts. What is account? Okay, so that only I am going for. What is account? I am going to make you understand what is account. Account or the book. in which you are preparing. An account is a record of all business transactions relating to a particular person or assets or liability or expenses or income. What is account? Account is a record of business transactions relating to particular person, assets or liability or expenses or income. Means it is a book in which all the business transactions can be recorded relating to anything. Relating to personal account means personal person or assets or liabilities or incomes or gains or losses, whatever is there taking place in the business, they all are recorded in the accounts. In accounting, we keep a separate record for each individual asset, liability, expenses or income. In accountancy, we prepare a separate book for each and every individual aspect of the business organization. It can be your liability, expenses, income, individual assets, all those things are prepared separately. Okay, the place where such a record is maintained, it is termed as account. A place where such type of recording is maintained in business organization, it is named as accounts or accountancy. Okay, and what type of accountancy is being formed? What shape it forms? It forms the T shape. Okay, you always remember it is in the T shape. If you can read over there, it is in the T shape. Understood? All the accounts are divided into two sides. All the accounts, different types of account, it can be cash account, purchase account, sales account, whatever account it is divided into two sides. The left hand side of an account is called the debit side and the right hand side of an account is called the credit side. Left hand side is the debit side and right hand side is the credit side. And it is written or abbreviated as CR and DR. That is, I have written over here that debit is DR and credit is CR. Okay, in this abbreviation is written, it is written over there, so that it is easy for writing. Not again and again you have to write debit and credit, the whole word over there. And accounts is also abbreviated, like account A/C. A/C is the abbreviation of account. Okay, now coming over here, the types of accounts or classification of accounts. How many types of accounts are there or what is the classification of account? Over here only you will get the other aspects of the accounting system. Okay, a small chart is being prepared by me, the account and the distinction between them. You can see over there. You will be getting the picture of the board very soon. Okay, so accounts are subdivided into two categories. One is personal and another one is impersonal. Personal, what is and what is impersonal, I am going in detail now only, but first of all understand what are furthermore inside that. In personal account, furthermore there are three types of accounts. One is natural, artificial and representative. Three types of personal account are there: natural, artificial and representative. In impersonal, there are two major types of account, that is real and nominal. Okay, real accounts and nominal accounts. Now, real account is further subdivided into two categories, that is tangible real accounts and intangible real accounts. Okay, this is the different types of accounts that we follow in our accounting system. So, starting from the personal account, what is personal account and what does it mean? Accounts recording transactions related to a person or group of persons are known as personal accounts. These accounts are necessary in particular to record credit transactions. Personal accounts are of the following types. Okay, so what is personal account? The account related to a person or group of person. Name only suggests you personal account. Personal means person's account. So if it is a single individual person, that is also a person's account, personal account, like Ramesh account, DR to cash account, CR, whatever you are entering in the journal entry system, journal books. So Ramesh account becomes the personal account over here. Understood? Or a group of persons. Group of persons means like you have done business with certain company or certain organization only. So there are group of people in that organization or group of people in that company and you have done business with that. And you are writing now like ABC Limited. You have paid 10,000 rupees to ABC Limited, whatever it is, whatever the name it is. So ABC Limited is what? It is a company name. Company name is not actually a physically existing thing. Okay, physically existing, the building is there, but company doesn't exist physically. Company is not a person. Okay, so you are writing that directly that ABC Limited, but in that ABC Limited, it is a group of people running that business. Maybe there are 4 or 5 people together, partners running that business. So actually you are writing all those partners name over there, but in a short form, that is ABC Limited over there. Now moving on to the different types of personal account. First one is natural personal account. What is this? These are accounts which relate to individuals. These are the accounts which relate to straight away individuals. Individuals means single persons. Okay. An account recording transactions related to an individual human being is termed as natural personal account. Which relates to the individual human being is termed as a natural personal account. You can take example Kamal's account or Mala's account or Sharma's account, whatever it is. Okay. It can be anybody. Maybe Kamal is your owner, Mala is your debtor, and Sharma is your creditor. So all those names will be recorded as personal accounts only, because they are all individual single person. Okay, living being. Number two, artificial personal accounts. Number two is artificial personal account. These are the accounts which relate to a group of persons or firm or institutions. Here comes the artificial personal account, in which group of people are recorded, or institution is recorded, or a business transaction name is recorded. Over here, not a particular name of a person is recorded. An account recording financial transactions with an artificial personal person created by law or otherwise is termed as an artificial personal account. ABC Limited or any other company name, it is a person, but it is created artificially by living beings. Living beings have only created that artificial human being or whatever artificial person, but and it is created by law. Law means they have registered the company name in front of the law or the business organizations, different business organizations, and they have got that name for that business organization, and you are recording that name only. So that name becomes a artificial personal account. It can be anything. HMT Limited, Indian Overseas Bank, Life Insurance Corporation of India, Cosmopolitan Club, anything, any company's name, any club's name, any organization name, business firm name, all this comes in the artificial personal account. Number third one is representative personal accounts. Representative personal accounts. An account indirectly representing a person or persons in is known as representative personal account. In representative personal account is such a type of account in which a person is generally not recorded directly, but indirectly some other account relates to that person, to any other individual person. Like I am giving you example, like outstanding salaries or salaries account. So salary, if you are paying the salary or you are paying the rent, okay, rent account, paying the rent to somebody, so you are recording rent account debit to cash account maybe. Okay, so rent account over here deals with the owner of the land maybe. Rent account deals with the owner of the land. Salaries deals with the employees of the organization. Okay, so when it is relating to some other personal account, but it is not recorded directly the names of those persons, but in other form, it is known as representative personal accounts. Okay, like prepaid insurance, outstanding salaries, outstanding rent, outstanding wages, whatever these wages, rent, salaries, insurance paid, all those things comes in representative personal accounts. Now moving on to the second type of accounts, that is impersonal accounts. We have done the personal accounts, now we are going on to the impersonal accounts. All those accounts which are not personal accounts are impersonal accounts. All those accounts which do not come in the category of personal accounts, that is your natural, artificial and representative also, all those accounts come in the impersonal account. But there are further subdivisions in the impersonal accounts also, we are going to deal with that. And namely there are two types of impersonal, that is one is real and second one is nominal. So what is real? Real account. Accounts relating to properties and assets which are owned by the business concern are known as real account. Accounts relating to the properties and assets owned by the business organization, it is named as real accounts. Like example I can give you, like land, building, goodwill, all the land of the company, all the machinery of the building, all the building of the organization, or all the goodwill, all these things, mainly the assets you can take, all the properties and assets, it comes in the real account. Okay, now real account is subdivided into two categories, tangible real accounts and intangible real accounts. Like tangible means what? You have studied in science also. Tangible means something which you can touch and feel. Intangible means which you cannot touch and you cannot feel, you can just feel it. Okay, but you cannot touch intangible. But tangible, both you can do. You can touch and feel both. Okay, so what are tangible accounts? These accounts represent assets and properties which can be seen, touched and felt. Okay, measured and purchased. Like example, machinery account, machines, all the machines of the business organization, you can touch them. Cash account, cash you can touch. Furniture account, stock account, land account, building account, all those things comes in the tangible real accounts. What is intangible real accounts? Which you cannot touch. These accounts represent assets and properties which cannot be seen, touched or felt, but they can be measured in terms of money. But they can be only just measured in terms of money. You cannot see or touch, but they can be measured in terms of money. Example, goodwill account. Goodwill means goodwill of a company. Like if there are two products in the market and you are going to decide with what product you are going to buy certain things. Like you are going to buy a torch only. You are going in the market to buy a torch for a house. One torch is of Eveready company, very famous company, or Duracell, very famous company in India. So it is there. And one company, one torch is there for maybe some other company, XYZ, don't know the company name only. Okay, first time you are listening. So which torch you would be buying? Straight away you will be going for the Eveready or Duracell, not for the any other company which is not known only to the people. Why? Because you know the goodwill of that company of Eveready or Duracell, that yes, this company products are very good, they run for a longer time and they are worth value for money. Okay, that is why you are going to buy those companies product. You are not going to buy this product. Okay, so that is known as goodwill. Goodwill account, patents account. Patents account means patent means you don't know properly. Any discovery being made, whenever a discovery, new thing is made, it is being patented in front of the government. Patented means you get the information, patent certificate that yes, I have all the rights to, all the copyrights for the production of this product and selling of this product. Nobody can copy from me and sell this product in the market. That is duplicating. You cannot do. So that is known as patenting account. Trademarks account, you also patent your trademark. Trademark means a logo type something. A company has its own logo. It cannot be copied by any other company. Okay, that is named as trademark. Copyrights account. Copyrights account only that thing only that you cannot, some other company cannot copyright it. Okay, now the third one. The third one not means the second one of the impersonal account, that is nominal account. What is nominal account? These accounts do not have any physical existence. These accounts do not have any physical existence like your intangible real accounts. Okay, no physical existence, you cannot touch or feel. Form of shape, they don't have any physical existence, they don't have any form, they don't have any shape. They relate to income, expenses, gains and losses of a business concern. They relate to all the income, gains, losses, all those things, expenses, all those things. This type of things comes in the nominal account. A separate account is maintained for each head like expenses, loss, gain and income. Wages account, rent account, commission account, interest received account are some examples of nominal account. Sales account and purchase account are also nominal accounts. Nominal accounts are of two types, revenue account and expenses account. Nominal account are further subdivided into two types, that is revenue or expenses, that is income or gain, losses. Okay, so these were the three types of these were the distinction between the accounts, and this is your first part of this chapter, and you will be getting your second part also, in which I will be completing this chapter. Okay, follow the book and read the chapter along with that, along with the video. That is all for now.